Ladies and gentlemen, good day and welcome to Q3 FY23 conference call for analysts and investors of Harsha Engineers International Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. I now hand the conference over to Mr. Vishal Rangwala, CEO and whole-time director of the company. Thank you, and over to you, sir.
Good afternoon, everyone. Thank you for joining Harsha Engineers International's Q3 FY2023 earnings call. I would like to walk us through results for Q3 first and talk a little bit about that, and then maybe Maulik will talk a little bit more specific about numbers. So to begin with, we continue to see respectable top line and bottom line in Q3 results despite very difficult market conditions across Europe due to energy crisis. This has a top-line impact in our Romania plant as well as supplies going from India to Europe. Further in Q3, due to strong zero COVID policy implementation in China, there was impact on China revenue as well. Couple of other factors, which had a top-line impact was one, material mechanism in place, and commodity pricing, price reduction linked to steel and brass commodity prices changing. So as well as our customers started doing a lot of year-end inventory control, resulting in overall softening of demand as well. So Q3 is definitely lower than our expectations. However, these are the significant factors which had impact on them. While we have improved our EBITDA and PAT over last year and last quarter, we are continuing to work on reducing cost, and obviously partial revenue reduction impact is due to material price adjustment. So we are keeping our EBITDA margins quite strong and intact. Considering material price change and pass-through as well as European demand softening,
Sir, if you could just move the mic a little more closer to you, as participants have just highlighted that they are not able to hear you very clearly, sir.
Sure. I'll try that. Hopefully this is better. So basically, we are seeing significant price changes because of material pass-through and significant European demand softening. And overall, there is a whole softening of overall market being there. In current year, we are looking at flattish top line. However, in EBITDA terms, in EBITDA in absolute terms will remain strong, as well as we will grow it as a percentage this year. We are seeing some impact in the wind market, specifically in Europe, which is very weak and which has some impact on our growth in bronze bushing business as well. We are closely monitoring how this situation is developing, and providing or actually guiding on specific how it's going to roll out over next 2 quarters looks very difficult at this point. But we are extremely hopeful that we will Q4 also will improve from here. while we talk about this, we are very bullish on medium to long term. Our focus there is for continued growth. The drivers for us remain the same. We continue to see new order wins, reference to China Plus One strategy deployment by our customer. We are increasing, focus on increasing business share within Cage. We are actually continuing to grow with our Japan origin customer base across the globe, as well as, we are seeing a lot of good growth possibility in bronze bushing as well as stamping products. Overall that we remain very optimistic and continuing on that path. And with that, I asked Maulik to about numbers.
Sure. Thank you, sir. Hello everyone. Good afternoon. We have uploaded the financial numbers as well as the investor presentations on our website as well as shared with the exchanges. I'm sure you would have got an opportunity to go through the same. Let me quickly touch upon the major numbers. For the quarter ended December 22, for engineering business at consolidated level, we have achieved a top line of 297 crore against the 318 crore in the previous quarter, as well as 312 crore in the same quarter last year. We have some degrowth of -7% and -5% respectively for that period. Against that, our profit after tax for engineering business for the December quarter is reported 32.1 crore versus previous quarter reported number of 27.7 crore with a growth of 16%, and 19.9 crore reported number of previous year quarter 3 with a growth of 62%. On EBITDA front at console level for engineering and solar business, we have achieved EBITDA of 18.1% as per the defined definition, and against the 16.22% in the previous quarter. With this brief on the financial numbers, I hand it over to operators to take over the Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harsha Patel from Equirus Securities. Please go ahead.
Thank you very much for the opportunity, sir. So my first question is on our overseas operation. So if you could indicate what was the revenue growth or decline was there in both our Romania as well as China operations on YOY and QOQ basis, and how has been the performance on the margins front over there? And in your opinion, how long could it take us to get back to the historical levels of margins over there? That would be my first question.
Sure, Harsha. For Harsha China, our quarterly numbers has been degrowth by -14% versus Q2, while it has grown by 17% on the year quarter 3. For Harsha China only, our EBITDA has remained good for the last quarter. We have achieved an EBITDA percentage of 15.6% in Harsha China on the top line of 27.9 crore. On Harsha Romania, our top line has remained at 50.3 crore with a degrowth of -6% over last quarter and -28% over last year quarter 3. Our EBITDA remain flattish, breakeven or zero in this quarter versus the positive EBITDA of 60 lakhs in the last quarter.
And Harshit, I'll address on the our overseas subsidiaries. I think we are seeing continued improvement on the margin side and EBITDA side. And we did have a difficult situation. We do have difficult situation last quarter in Europe and as well as in China. And part of this volume recovery happens. We are quite confident that we will be positive margins or positive bottom lines we will achieve in next few quarters and grow from there. So that's the idea.
So thank you very much for that. My second question is on our bronze bushing business. As you have mentioned in your press release, as well as you also told us that there is a bit of a slowdown because exports from India are suffering, the exports to Europe. So where would be in terms of our growth trajectory in that business? So will we be able to achieve our FY24 guidance at least? I believe FY23 could be a little bit of a problem. But are we on track to do that 100 crore kind of sales next year?
Right now, exactly to define that becomes challenging. That overall order win remains with us. How that market recovers, how fast remains, a question. So what we are hearing from our customer and overall wind market, that second half of calendar year 23 will be much better for wind. So as and when how that revival happens will be dependent on that. But in terms of opportunity and in terms of potential of the business, we are near that number 100 crore, and that whether we are able to successfully do 100 will depend partially on the market situation.
Understood. That would be all from my side. Thank you very much for taking my questions. I will join back the question.
Thank you. Our next question is from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, so thanks for taking my question. First question is on, now, as you already highlighted, we are facing some slowdown for exports and bronze bushing also offtake has been lower and maybe that will continue for 1-2 quarters. So now the kind of guidance which we were providing earlier on the top line growth and, obviously the margin improving and we used to talk about, India margins at least improving significantly and a much higher contribution from bronze bushing over the next 2 years. So are we still remain firmed up on this or any change of stance which is happening?
Am I reading, Amit, your question correctly, that what is the growth guidance for 23-24 that we are looking at?
Yes, sir. FY24-25. Any changes? Because now we are seeing bronze bushing also seeing lower offtake, and we targeted that this will be also a major contributor.
So just as Vishal explained in his initial comment, this is Sanjay here. As Vishal explained, what is happening this year is definitely looking flattish in terms of the value. Having said that, there is definitely a volume growth, though not again in our case strictly quantifiable, but anywhere between 7 to 8% or maybe even a little higher volume growth you will definitely have seen even this year. Next year, now what is happening? One, all the growth drivers are intact, but next year we believe that we will wait at least for this quarter, the Q4 of the current fiscal year to go before we want to actually quantify that what could be the growth guidance for 23-24. Having said that, our target of a consistent medium to long term opportunity-wise, a CAGR growth of 10 to 15, around 15% is what we are targeting, and we are very confident that that should happen. But for 23-24, we want to wait for one more quarter and then give sort of an indication, given the fact that we are facing lot of uncertainties, and it's not exactly possible to quantify at this point in time. So let's wait for Q4. Having said that, it doesn't dilute the opportunity or the growth story in any way, but it's just a medium to short-term problem that we are currently facing. But I think it would be only fair to say that let's wait for one more quarter, and we'll be able to then give you a little more exact indication about 23-24.
Sure. So, sir, is it our customers are seeing lesser offtake, or is it the overall wind market?
So I think it is both. We are seeing a less offtake from our customer because they are also already cautious about the impending recession, as well as the overall market is softened. Having said that, specifically we see that in Europe that is significantly impacted. Other regions we don't see a very significant impact, but it could come in. So that's why there is a lot of uncertainty because linked to that.
Sure, sir. And on the increasing customer wallet share, we talked about Japanese customer. That's where we are focusing on, and obviously the outsourcing of large cages. So are we moving progressively there? Is there any development there? Any contribution, anything which has happened?
Yeah, I mean, in general, we are moving in that right direction. We are winning a lot of business with Japan origin customer base across the globe. Their growth, 30 to 35% plus growth we are seeing for that customer base.
In the current fiscal.
Correct. Yeah, currently. We are for the 9 months so far, right? And beyond that, even large size cages, we are winning a lot of orders. Part of it is we are now testing and outsourcing. We don't have a specific large order to be shared that this significant has happened, but it is a very incremental journey. And we are continuing to see traction on both those fronts.
That's pretty satisfactory, yeah.
Sure. Thanks, sir. My last question on anything on railways. We saw this has been a good focus in budget also on railway side. Any company specific benefit which we are looking in coming years on the railway side?
So we have, railway, we are seeing a significant growth, specifically, one product we have just developed, which is going into the railway. And another product which we have actually, our customers were importing, and now we have become the substitute for that import. Where in that situation we are ramping that up, that product. So we are seeing significant growth within that railway, or rather we will continue to see this year, calendar year 23. So very hopeful, but again, those numbers are in range of 20%, 30% plus overall, based on what projections we have seen, if we are able to fully realize that import substitution. So very hopeful, very aggressively looking at that right now.
Sure. Thank you and all the best, sir. Thanks.
Thanks, Amit.
Thank you. We take our next question from the line of Pradyumna Chaudhary from JM Financial. Please go ahead.
Yeah, hi. So we've done very well in terms of EBITDA growth, absolute EBITDA growth on the engineering consolidated side. So I just wanted to understand the reason for the same.
Yeah. So I think one important thing here that I mentioned is that because we have a material pass-through mechanism, and as Sanjay mentioned that we think that we still grew respectably in spite of these headwinds we are facing. So basically our EBITDA absolute margin remain intact in spite of, if you look at quarter three, a little bit soft. So that is basically leading to the EBITDA growth.
Major contributor being India. India has reported a very decent EBITDA.
Yeah. So just to add on both the points, Vishal has said about the pass-through. Plus, we also have a good amount of exchange rate benefits in our EBITDA, which we have already
realized in our which is already realized
and which is there in our investor presentation.
Sorry, I couldn't hear the second reason. One is pass-through. What's the second reason?
Second, Maulik said that we have a good, decent realized exchange rate also booked in the current quarter. What is actually realized by us?
Okay. And so one thing I noticed was our revenue on a YOY basis, I'm talking about Q3, our revenue actually has declined by 7%, I think by around 7%, whereas our COGS has cost of goods sold has declined by 17%. So is there any chance that not all of the price decrease of metal has been passed on to the customer?
Yeah, so we have discussed that our price pass-through has a lag, which is 3 to 4 months lag, depend on customer to customer, and that lag always give either a benefit to the company or a hit to the company for a quarter period, and that is being reflected now.
So having said that, this is always a constant process, and there is a little bit of lag. This goes on. So exact mathematics is very difficult to say, but that does not mean that automatically Q4 margins will be further subdued. It also means that there will be new orders where we will get better margins. Some orders we will have a little pass-through effect. On an average at India level at 20% around that EBITDA we are maintaining. As Vishal explained, hopefully China EBITDA will further improve this Q4. Romania, we are keeping our fingers crossed. Very honestly, we don't know. But let's assume Romania remains more or less in this territory of zero or a very marginal 1 or 2%. That would mean that Q4 I should see more or less a similar operating and net margins happening, which will mean that as compared to last year, there is a very decent margin growth this year, notwithstanding the fact that at the top line level we are flat. This is the sum and substance of the current year as we see.
Understood. And in terms of YOY in Q3, what is the volume growth?
See, again, I'll be very honest. We have a brass, we have a steel, but thumb rule would be maybe around 7 to 8%.
Okay. Just one request before I just conclude. Would it be possible, like, of course, we are a price pass-through company and we get seriously impacted by, like our numbers get impacted by the commodity price fall or rise, right? So some sort of disclosure on, I don't know how, but maybe something on the volume side in your presentation going forward so that we are able to better assess the business performance would be really helpful.
No, I appreciate your point, but let's understand the difficulties that we face. So we have a 7,500 SKUs, and there are so many different parables and factors. So that, for example, if I'm talking of brass, we have X volume but giving a much higher average realization. When I talk of steel, we have very small 20 mm, 30 mm, 40 mm products, BGBB, etc., bearing cages where it's very high volume but the average realization is very low. So, I'll be very honest, we will still want you to look at us as a percentage EBITDA. It will be very misleading for me to say that this is average realization per piece, because I don't want you to promise something which we can't deliver.
Absolutely.
Okay. Understood. I understand. Thank you.
Yeah, thanks.
Thank you. Our next question is from the line of Dhananjay Maji from, an individual investor. Please go ahead.
Good evening. Is I'm audible?
Yes.
Yeah. Sir, your casting products have low margin, which might be dragging your margin down. So how you would be offsetting? Is that only the product that is brass bushing?
So, no. So I think our casting business, we only do semi-finished business in Europe, out of our Romania facility. Otherwise, our focus is on finished product business, and the bronze bushing is actually a finished product with a respectable margin. The casting business, which is relatively lower margin, only exists in out of our Romania facility.
And as you rightly mentioned, being in Romania, energy crisis has hit us hardly last quarter, and which makes it zero EBITDA for the ceremony.
Okay. So my next question is, by any chance, if the demand for sensor embedded bearing increases, or are we having any capabilities of supplying those? Or let me modify the question. In short, how are we molding ourselves towards Industry 4.0?
Yeah, so, see, there are two aspects of this. One, how we are working internally, we are actually aggressively implementing Industry 4.0 internally to really give us the benefit of optimization of cost, efficiency, as well as, just in time and all that. So there is a significant in-house program which we run, linking all our machines to our central system, and how we create the signal and all that, so that right maintenance, right attention can be given. So that is how we do internally Industry 4.0. Having said that, our product per se, when it goes to bearing, our product has no impact whether this bearing has a sensor built in or not. We are agnostic to that. And even with the sensor built, bearing, the similar or the same cage goes in, this is being a highly precise product. So as such, that's how it is. However, to take advantage of this trend, we are within our, we have a injection molding cages also, and injection molding capability. So we are working with some of our customers to supply additional product within bearing side, so that we can give that, that molding or a plastic component which incorporates the sensor as an attachment to the bearing. So that's something as a small way we are working on. Beyond that, as I mentioned that, bearing cage, our main product remains same irrespective of, whether it's a censored bearing or not.
Okay, and my third question is actually your plants were facing issues due to energy crisis in Europe. You mentioned here also. So on the prior call, you have mentioned that there would be demand for some product. So have you generated any revenue, or have you generated any order from that country?
Yeah, so what we mentioned is that we are working to grow demand for finished products, which is cages, out of our Romania facility. Currently, considering overall demand situation in Europe, that demand remains muted. However, we are continuing to work in our business. The order gestation realization cycles are long, where we have to actually, when someone awards us a business, we go into product development, we validate those products, and only after approval, we start series production. So there are some wins in pipeline, and we are also very hopeful that additional opportunities will come our way, and we will grow that business. But I don't have any specific large order to talk about today.
Okay, no issue, sir. So thank you, sir. I'm done.
Thank you. Thank you.
Thank you. Our next question is from the line of Shirom Kapoor from Prabhudas Lilladher. Please go ahead.
Yes.
Hi. Hi, thanks for the opportunity. One question. So in our EBITDA, I understand in your disclosures, it includes other income, and other income has come significantly higher this quarter at about 13 crores versus only about 2.5 crores last quarter. So, stripping out this other income, are we still going to see EBITDA margins rising significantly? Because I feel it's getting a little bit skewed based on our other income increase.
So, if I understand your question correctly, if you are comparing other income, please understand that this year we have a portion of almost 5 crores, which is the realized FX. When I say realized, that means whatever is the difference between the booking of the sale and the actual realization, it has been realized during the quarter, and therefore it is in my pocket. So, in my humble view, as an export-oriented company, the realized foreign gain is an inherent part. So, if, for example, there is a loss, that loss gets booked as other expense, and which is a part of my operating cost. Therefore, my other income, which is realized, should be a part of my operating income and not my non-operating income. So, if you remove the realized gain, or if you consider that, then there is no difficulty in terms of comparison of the margins at the operating level. Yes, there is a treasury income in terms of interest, that is fine. Similarly, there are the mark-to-market currency. So when I translate my closing balances at the current currency level, there is a mark-to-market translation gain, which could be reversed or which could be maintained depending on how the currency fluctuates. So that is fine. I mean, that as a part of your analysis, if you remove, that is perfectly okay. But I think if you consider the realized gain, we are okay. There should not be any problem.
Understood. Thank you. And my next question is regarding, we've seen a higher percentage of sales as your other expenses and employee benefit expenses have increased as a percentage of sales. So, going forward, if your realizations continue to fall and that impacts your top line, will you continue to see this percentage grow? Or is there any one-off this quarter that caused your other expenses and employee benefits to increase versus last quarter?
So at Concall level, some employee benefit expense has grown up due to 13th day in Romania, being a Christmas quarter. And otherwise, what we have observed is on account of the metal price reductions impacting the top line value getting down. So indirectly, it increased the percentage terms. While in absolute terms, if you observe, it remains more or less constant or a regular increase year over year.
Okay, got it. And last question is, on your precision stamped components business, do you have any updates on this? Any numbers you could share in terms of growth or margins for this?
Yeah, I think I can share just a directional and what we are seeing in terms of specific number. It will be difficult to share. Directionally and on the ground, we are seeing significant growth specifically in this business. Again, we are starting from a relatively small base. But we are seeing this year, about 25% plus growth in general in that business. And with the order wins in the pipeline, I think we are very bullish and hopeful on that business in general. Overall margin point of view, it's in general very similar or slightly lower than our average margin for standalone basis. That's the general what we can share. Specifically, we are not separating those out of overall.
Okay, got it. And these components are primarily exported or are they sold in India? Because if there's softness in Europe, will this also get impacted?
Yeah, no, right now the majority of business is bound for India, with some opportunity outside. But major focus is India. That's where we are growth. Yeah, I mean, right now we are not seeing any impact related to Europe or anything in this business.
Okay, understood. Thanks, and all the best.
Thank you.
Thank you. Our next question is from the line of Prolin Nandu from Goldfish Capital. Please go ahead.
Yeah, hi, Vishal bhai. Couple of questions from my side. The first one would be, even our domestic or engineering standalone business has two elements to it. One is what we supply within India and what we export out of India. How different are the margins for these two businesses, for the domestic as well as the export part?
They are fairly similar. There could be obviously pockets and things and opportunities which could create a differential. Obviously, export business. If I look at historical trend, it gives us exchange rate related benefit, which probably improve just because of that inherent advantage built into it. Beyond that, depends on the situation to situation. Per se, domestic or export would not necessarily have a different margin profile.
Sure, sir. And just on this, exchange benefit part to it, right? In the past call, we have mentioned that if I'm not wrong, we hedge 50 to 60% of our currency exposure. So correct me if I'm wrong, this exchange gains that we are talking about would not have accrued had we hedged completely 100%. Is that understanding right? Back to back when we win orders, if we would have had 100%, we wouldn't have got any exchange rate benefit. Is that understanding correct?
So on the forward which are settled, it will be part of our realized gain, which are not settled in the terms of forward or options we have taken. It is part of our other comprehensive income, and it is not there in the other income. Whenever it will actually settle, it will fall there.
No, but to answer your question directly, I think yes, you're right.
Yeah.
So sir, I mean, what is the cost benefit? Have we historically done that analysis that why do we want to take calls on exchange rate and why not hedge 100%?
Oh, so it's a very interesting question. And so at the board level, the policy is that what is our ultimate aim? Our ultimate aim is to protect our margins, correct? So in a volatile situation, what is the safest way to ensure that, remain 50-50 more or less? So you hedge 50%, keep your 50% positions open. So either way, if situations change on the extreme, for example, you are right, this time it was extreme. I think we closed the exchange rate at little over 82, correct? And my normal average hedges were maybe in the region of 79, 80 or 81. So here technically and theoretically there is a loss. Now imagine a situation where supposing the currencies at rupee terms would have strengthened and we would have closed at 78. Then in that event also I would be more or less on the benefit side, my forwards would have given me a better realization and my open positions would have incurred some notional loss. So, this is a volatile situation. It happens. I think this 50-50 remains a fairly decent via media to ensure that we are either way we are okay.
And I think again, what we are doing again, this hedging process is short term.
It's a rolling forward. It keeps on rolling.
Right. And all our material pass-through mechanism also takes care of a significant chunk of the variation which happens on terms of cost basis, right? So I think when it comes to protecting long-term margins, these material mechanisms play a significant role. And short-term margin protection, we are just going with the hedging policy we are deploying.
Because in material passes, some benchmarks are foreign currency.
No, that's fair, sir. But I mean, historically, we have seen, lots of, in case if we keep unhedged, right? And the currency does not move in our favor, then there is a lot of volatility in the earnings. That's a limited point I wanted to make, right? In some sense, we should probably focus on our expertise in terms of, converting and, those kind of margins and not that. So that's just a suggestion, right? In terms of doing a cost benefit analysis of hedging the exposure completely. So just a suggestion. And the question on my question is on bushings, right? In some sense, now this time we are mentioning that there has been a slowdown in the market. So this bushing market, in terms of customers, they are more or less domestic customers, right? Am I correct?
So our customers currently are primarily domestic, but ultimately they are actually exporting the product.
It's a gearbox manufacturing companies which are exporting gearboxes and supplying mainly to wind market.
I get your point. So that's what in the last call you had mentioned, that these customers who are domestic will ultimately be exporting. But when it comes to this particular bushing, they are importing some component, right? In some sense. So I thought that even that slowdown that we are witnessing in an overall wind market should have, this whole import substitution mechanism or whatever, that trend should have cushioned that to some extent, right? So is that happening? For these gearbox manufacturer, import component is coming down and our supply is going up. Is that happening at least?
Yeah, so that has happened actually in a significant way, and that's why last call we had expressed that, even though there was already some amount of wind slowdown happening in the market, we were not experiencing because we were largely focused on becoming the import substitute. Once we hit that reasonable or a complete import substitute status, we got the direct impact of, the market condition or market situation. So we have actually successfully created a substitution in one case, and another case we are in process of creating that 100% substitution. So we are very hopeful that we should see improved situation, because as I mentioned that another case we are working on becoming that import substitution, where we are approved supplier now and we have just started series production and all that. So with that, we are confident that we will see some improvement going forward, but currently the demand where we have already achieved the substitution remains very challenged.
Understood. And from your customer and all these redesigning of windmills and gearbox that you had mentioned last quarter, that is largely done, right, in some sense? And our products have also been approved in one case, and in the second case we are in the process of getting that approval, or so all the redesigning part is pretty much done, right?
We see that the next gearbox is under redesign. So we are working with our customer on developing those next set of products. As I think my earlier conversation was about how this conversion is rolling on in the industry, this conversion from bearings to bushings. And our guesstimate today is that about 15 to 20% conversion has taken place, and next set of conversion will continue to roll next 4, 5, 6 years in the industry. So that conversion is in process of taking place.
Understood. Fair point. One last question on your international business for your Romania as well as China subsidiary. Now, China margin is quite heartening to see that they are already at 15% and much near to our overall consolidated or standalone numbers. Romania is something where, as you have mentioned last quarter, that you have passed on some sort of a price increase to your customer. So while slowdown it would be fine on the top line, that top line has declined this quarter, but I would have assumed that profitability would have gone up. But your comment suggests that last quarter we were very minor profitable, but this quarter we are moti break even, right, in some sense. So could you help us understand not just this short-term profitability in Romania, but 2 to 3 years down the line, what is the number or what is the range of Romania's margins that we should work with?
Yeah. So, to answer that question, immediate short-term question, obviously in Romania there was some volume impact because of overall Europe situation. Also, there was further increase on the energy side last quarter, which we are in process of passing through to our customers. So there was some impact related to energy prices. Even though if you look at, we have kind of bridged the gap per se versus the previous quarters. Now, in a long-term basis, when it comes to Romania, we are looking at EBITDA margin for the casting business about 6 to 8% EBITDA margin. We think we can fairly sustain. And for a finished product business, about 15 to 18%, 15% to 16% EBITDA margin is we think we can fairly sustain. As a combination, we are looking at about 9% EBITDA margin in a midterm coming out of Romania. And working towards that in terms of growing the finished product, stabilizing in terms of cost and other things, the semi-finished casting product and all that.
Sir. One last bookkeeping question would be, we have, if I'm not wrong, our gross block is close to 820 odd crores. Can you help me give a breakup of how much of this is domestic and how much of this comes from two of our bigger subsidiaries in China and Romania?
So, roughly 500. 500 would be domestic, 300 would be China, Romania.
Yeah, but precisely you have our reports available, annual reports.
This is very, top of the head number.
Yeah.
Great. No, thanks a lot. Thank you for that and all the best.
Thank you.
Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, a very good evening.
Good evening, Sandeep.
Pertaining to this, pertaining to this 9-month sales number that we have reported, if you could broadly share the breakup between cages and scrap within that, broadly how it would look like.
Okay. Give me a moment. Meanwhile, Sandeep, if you can move to your next question, I will give you this.
And also, when you share that, Maulik bhai, within that, if you could share out of these cages, how much was exports from India? So that would just give a sense to compare, how that number has changed year on year.
Yeah, that is there in our presentation, exports. I can tell you.
1 second, yeah.
So export from India as of now is
9 months figure,
48 to 49%, 9 months, YTD.
48 to 49% of cages sales or of total India sales?
Total sales.
Of total sales. Okay.
Yeah, so if you remove the scrap,
And our scrap for the 9 months YTD is around 123 crore.
so about 16%. Yeah.
Which is, that's standard only.
And this exports, how it would have fared year on year, if you could give a sense broadly?
Can you help me your question? Sorry.
9 months to 9 months, how the exports have?
So the last year our export was around 51%. 50 to 51%.
That has gone down to 48 to 49% now. Got it. Second question was basically when we look at the EBITDA numbers, you clarified that one should add back the realized gain within that. So when I add back this 5 crore number, which is realized to the EBITDA number, then that is what EBITDA growth is. Ideally, we should look at what the company has sustained. That is the correct way to assess that, right?
Yeah, but with a rider, Sandeep, that this is a consolidated number where my Romania EBITDA is 0. And my China EBITDA is also, although in terms of percentage good, but because the top line is impacted in volume terms, it is low. But yes, at an operating level, we are very clear that we should look at about 15 to 16%, and slowly and steadily we want to grow it up to 18% over the next couple of years.
Right. And just to clarify, when we mention that we are hedging our forex exposure, there will be some near-term translation losses also, as in mark-to-mark losses also. And when currency rate moves up, say it moved up from 79 to 82 in the current quarter, next quarter onwards, 82 will become the base rate at which we charge the customer. So the next hedge will get pegged at 82, and it will become part of top line. Is that correct understanding?
Sandeep, the understanding was when we do the material pass-through, the benchmark numbers are itself in foreign currency, and it gets converted on the average exchange rate of the same period. So indirectly, there is a pass-through covered in the material pass-through. There is an exchange rate also gets covered, and that's why we follow the 50% hedging strategy.
Correct. But when you are
raw material cost.
Correct. But when you are, say, forecasting for forward quarters to the customer, the billing happens in foreign currency. So the benefit will essentially become part of top line, and it will move out of other income gradually, which is why
you got it right.
Income. Yeah, got it.
Yes,
got it. And lastly, just on the Japanese customers, you briefly mentioned the growth numbers. I know the base is small. Is it possible to quantify for the current 9-month period? How big would that be, or is it too small to quantify?
So all the Japanese customers put together, not all, but the major 3 Japanese customers, our top line for 9 months is 49 crore, roughly.
Got it.
Which was 47 crore full year last year. Last 12.
47 crore full year in FY23.
That's right.
47 crore. Got it. All right. Thank you so much, gentlemen, for taking on the question.
Thank you, Sandeep.
Thank you. Our next question is from the line of Dhananjay Maji, an individual investor. Please go ahead.
Thank you for taking my question again. So for a short term, there is a high inventory in your business, as it is only 5% of the total bearing cost. So your cages, I'm talking about the cages. So how are you managing those things?
Okay. Can you repeat?
High inventory. So we maintain finished goods inventory across about 20 plus warehouses across the world, which is a major component of the inventory. Raw material in terms of number of days still remains around 24 to 25 days. WFN finished goods about 45 to 44, 43 days. I think it's almost, in terms of number of days, almost the same as you compare it this year. 1 or 2 days plus minus is something, we can't actually control.
Okay, no issue. And so what is your capex expectation for the next quarter or the next year?
So we have actually we have approved capex from the board for this year of about 70 crore. 100 crore. Sorry, and right now we have actually, I think in our presentation we have shared that about 50 crore is what, including WIP, we have spent this year so far. Immediate capex short term will depend on, we are looking at setting up the third facility in India. So it depends on, that investment when that happens. there is some uncertainty about it. It's a little bit of longer process to actually acquire land and execute all that. So I'm not able to accurately share that, but that's one of the biggest ticket item in next quarter or this quarter coming up. Plus, there are a few. So plus there are few other capex plan, but obviously we have slightly slowed down our capex expansion or addition because of little bit slowdown in European market and a little bit of potential of other areas also slowing down. So that's the status today.
Yeah, but medium to long term target remains the same as you had shared on the earlier call, about 300 crores in 3 years, 100 crores per year. That's what we are looking at.
Okay, sir. And sir, about your EPC business, actually that made a loss, I think. So, if I'm not wrong. So, can you please convey some color on those things?
Yeah, so our solar EPC business, this is primarily a project business. As we had mentioned earlier that our objective in this business is to focus on profitable projects. We believe that we have successfully done this this year, even though you're correct that last quarter we have made the loss. Now this is a cyclical business again, driven by fourth quarter. Basically we are looking at a significant top line growth in fourth quarter. And having a fixed cost structure to this, where we have a low revenue quarter, where as an example, last quarter where lot of projects not in pipeline or not on completion level, then we will see that. But overall, we are quite positive of that business on an annual basis. Be positive. I think on the 9-month basis also, it's just breaking even. So that's the concept and idea. This remains again a small business for us with not a focus of investment or significant growth. But we are very mindful of not losing money in that.
Okay, sir. Thank you.
Thank you. Our next question is from the line of Shirom Kapoor from Prabhudas Lilladher. Please go ahead.
Hi, thanks. I just had one follow-up question. So I noticed that you have utilized all the proceeds in the IPO that were earmarked for debt. So would that debt repayment have come in your long-term or short-term debt? Would you be able to share that?
Sorry, your question is that we have repaid the debt.
Yeah, so was that your short-term or long-term? So was that repayment in your short-term or long-term, the remaining amount from in Q3 that you repaid, was that in short-term or long-term debt?
So we have repaid the India debt, both all short-term and long-term, which was mentioned in our prospectus. We have recently borrowed further on the working capital requirement on our EPC front in India, while the debt in China and Romania remains the same because the proceeds has not been used towards the repayment of the subsidiaries money.
Okay, understood. Thanks.
Working capital.
This is export packing credit,
Export packing credit.
That is, which is very cheaper.
Okay, so the working capital is primarily for your subsidiaries, not for India.
No, even at India level, your business we can borrow at a very competitive rate in foreign currency or in local currency. There's an export finance, and we keep on taking it as and when required.
Yeah.
Okay, got it. Thank you so much.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference back to Mr. Vishal Rangwala for closing comments. Over to you, sir.
Thank you, everyone. Appreciate you joining this call and hearing through us update about our third quarter. Please reach out to us if there are questions. Thank you very much. Thank you for the participation.
And have a good evening. Thank you.
Thank you.
Thank you, members of the
Thank you.
management. On behalf of Harsha Engineers International Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.